Welcome back to today's edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com. You can find all of our podcasts and our videos right there on our website. If you simply go to the top of the website, there's a podcast tab and a YouTube channel tab. If you subscribe to our YouTube channel, we'll update you with all of our new podcasts we release every week, like this one with Chris Kimble from Kimble Charting Solutions, realinvestmentadvice.com. Chris, just before the break, we were talking a little bit about this downturn in the market here over the last few days. You know, the market's had this, this phenomenal advance since 2018, December the 24th. Steve Mnuchin comes out, says he's calling the plunge protection team. Donald Trump coming out talking about we're going to get a trade deal done with China. Fed Powell doing a complete 180 on his policy stance, gave the bulls lots of room to work here in an environment where we had weakening fundamentals, weakening earnings, weakening revenue growth. But overall, it's been a stellar advance. The question that we left off with is, the markets has kind of run into resistance here at previous highs, downturn breaking the 50-day moving average. I left off with the question, is this a buying opportunity? If I'm bullish, should I be buying this correction here? Or since we're heading into summer after a very strong first quarter, really first 4 months of the year, should we be looking to have a little bit more cash and maybe being a little bit more cautious here?
I do the latter choice, Lance, as far as being more cautious, because we are, again, at the top of the range. One thing you mentioned earlier in the show is when we go back and look at the 2018 highs and earlier in the year, whether we look at the New York Stock Exchange, EFA, emerging markets, a lot of the world has created lower highs, Lance, versus, any kind of higher highs. And so we're at the top of this range right now, and so I think it's a time to be very cautionary. And one of the charts that we've shared with your viewers is going to be the semiconductor index. And one of the things that recently, Lance, the semiconductor index did break its SMH, as you know, did break above last year's highs. But all of a sudden it's having a chance to use that old resistance, Lance, as new support. And it could appear in the last day or so that it's actually failing. And so this is one of the great leadership sectors of the broad market that's sending a cautionary, if not concerning, message to the S&P 500.
What about interest rates as well? Are you and particularly not only interest rates but also commodities? When you start talking about SMH, in particular semiconductors, that is very much a cyclical commodity. It has a lot to do with economic cycles. And I know you're a technician, but technicians, like myself also, there is a relationship between price action and what's happening in the economy. And sometimes we can look at these sectors that are cyclically impacted, like semiconductors, and we can also make a call kind of basically what's happening with the economy as well. When you start taking a look at commodities, interest rates, are you getting some of that same kind of sense that the economy may be weaker than what headlines suggest?
We're starting to see some of that, Lance. A great tool is looking at the copper-gold ratio, which is sharing weakness, copper sharing weakness of late. One of the charts that we shared with your listeners is the Thomson Reuters Equal Weight Commodity Index. Since 2011, Lance, they've made a series of higher lows and lower highs. The quasi-rally that we've had over the last few months is hitting the top of this 8-year falling resistance. It looks to be forming a bearish pattern, and so if we would see support here, this leading commodity index would suggest, or the patterns, Lance, would suggest at least a 10% further decline in commodities, which, as you know better than I, that's a fundamental suggestion of global softening.
That's an interesting point you bring up because, if you take a look at things like copper price, Dr. Copper, why do they call it Dr. Copper? When people talk about copper, they go, it's got a PhD in economics. And the reason is we use copper in everything, right? Whether it's your phone or your, even clothes in a lot of cases have copper threaded into them. I mean, you name it. Copper is just about everything that we use or consume. It's kind of like gasoline, right? Oil prices, oils in everything that we consume, eat, produce. It's either involved in the transportation or the making of at some point. So when you talk about copper, it's got this real high relationship to economic growth, yet copper really hasn't participated as much as the economy. When we're talking about, record low unemployment and record low jobless claims and, surging economic growth, if you listen to the White House, copper has never really confirmed that is indeed the case. And unfortunately, when we dig down into a lot of the economic data like employment, yes, we have record low unemployment, but we have 190 million people sitting outside the labor force. Dr. Copper may be much more accurate about predicting what's really happening in the economy. Do you agree with that?
I do, Lance, and it's a fair question to say, has Doc Copper lost his edge?
Yeah.
But I think in time though, we can play. It could play a game of Heinz ketchup. That Doc Copper has been accurate as far as lack of worldwide growth. Lance, we're seeing definite gains in the stock market itself, but the interest rate environment is not suggesting. We've always talked about, Lance, I know that you have, is are bond traders smarter than stock traders? And so when you think about overall yields, the 10-year yield, the S&P, and crude oil, they all peaked in October together. They all bottomed around Christmas together. They've started rallying, but yet who's diverging of late?
Right.
And it's actually been yields. Yields haven't bought into what's taking place in crude and the S&P. And one of the charts that I've shared with you is that crude oil, Lance, hit its 61% Fibonacci retracement level of last October's high to the December low, and then guess what? 2 weeks ago, a large, we'll really dig deep here, but the candlestick bearish reversal hammer pattern. Big deal, right? It is.
What the heck was that?
No kidding. I just wanted to wake up your listeners and fall asleep on this. But anyway, a heck of a reversal pattern took place that the traders tried really hard to get a breakout going, and they failed. And so since then, is it the chicken or the egg? Is crude leading the S&P or S&P leading crude? To me, it looks like the crude, Lance, is actually leading the S&P to the downside.
I don't disagree with that. One thing I've talked about for almost 4 years now is yields. And, for the last 4 years, whether it was Jeff Gundlach or Bill Gross or a variety of them, all talking about how the bond bull market was over, interest rates had nowhere to go but up. And I've been a big kind of an opponent of that, saying interest rates can't rise, because if interest rates rise, all the debt we've got in our economy, from corporate debt, junk bond debt, mortgage debt, credit card debt, etc., all gets impacted very quickly. And sure enough, right behind me is a chart of the TLT, which is an ETF of the 20-year bond. This is a price, not yield. But what we saw here is when interest rates went up in September, October, November of last year, the price of the 10-year bond had gone down really ever since January of that year. And in that decline, which was only a small blip, we went from about 2.5% on the 10-year yield to about 3.2%. And in just that little bit of movement, auto sales crashed, home market buying crashed, mortgage applications crashed, delinquency rates started to rise. All kinds of bad stuff happened really quickly. And since then, rates have completely reversed here. To your point, Chris, I think bond traders figured out real quick that rates don't have really anywhere to go but potentially lower here. And if we hit a recession, which was interesting, a chart out this morning showing the Deutsche Bank recession in 12 months prediction, now at 27%, highest level since 2007. We are tracking that type of rise in recession risk, which maybe is what bond yields are telling us. What do you think?
Yeah, I do. I'm with you, Lance, on that. It's just the bond market does not seem to be buying into the growth story. Like you mentioned earlier, there's stats out there, unemployment. Just a lot of stuff looks really good, but for whatever reason, as you know, Lance, and the listeners most likely are aware of, the bond market doesn't like good news, and they don't seem concerned about this being good news. Actually, they're not taking it that way, and so I think that's something to really pay attention to.
Well, I think it's also real important here as we head to a break. I think it's real important for investors to remember one thing. We tend to get lost in the good news, right? Record unemployment. Record unemployment doesn't happen at the beginning of a bull market. Record unemployment happens at the beginning of recessions. And again, bull markets are born out of really, really bad news. Bear markets are born out of really, really great news. And right now, when you look at record unemployment, record jobless claims, I think what the bond market is starting to smell out is that, well, this is as good as it can get. And if we take a look at some of the underlying internals, those are beginning to deteriorate. And the trade has been to safety. Even retail investors have been buying more bonds and equities this year, which may be emblematic of itself. Of course, stock buybacks have been making up about 80% of a lot of the volume here. So that's a whole different topic for another day. But we'll come back after the break with Chris Kimble. I want to wrap this up talking a little bit about the market itself, understanding technical analysis, importantly, as it relates to managing your portfolio. There's a lot of misunderstanding about what being a technician is and how using technical analysis, what it actually does in a portfolio. So we're going to have a little bit of an educational talk. We'll come back with Chris Kimble, KimbleChartingSolutions.com, right after the break. Don't go away.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.